Welcome to Financial Revelations. I am David Safransky, your host, a real American and the voice you can trust. I want to let you know that we have a new production staff. And so if things don't look exactly like they have in the past, we're learning some new things, we're doing some new things. Be patient with us. The information is going to be top notch as always. And I want you to know, if you want to, you can reach out to me on Twitter at SkiBucks1. You can text us. There's a new address, Corey at EPSF.com. Corey at EPSF.com. And as always, you can hear me Thursday mornings on WCRF in Cleveland or anywhere in the world because it's online. So you can go to their app, Moody Radio's app, and you could choose WCRF from 8 to 9 a.m. And that is WCRF 103.3. Thursdays, 8 to 9. And you can always call here. If you have a question and you just want to ask the question, the number is 1-800-344-2534. And about 90% of the time, that 800 number works. I don't know what happens. The other 10%, it must be squirrels or something. But so if you have that question, Corey at EPSF.com. I think that's going to be up here on my copious forehead. But if it's not, you can call. And so we're back in production. Josh is moving on to greener pastures, and of course we wish him well and the best of success. He's a recent college graduate, degree in accounting, and so he is out in the world. So since we last met, Chair Powell raised interest rates by 50 basis points just yesterday. And, it was expected. We thought that he was going to do that. It wasn't a surprise whatsoever. There was some question on whether he would go 75 basis points or 3/4 of a point. But he didn't. I had predicted 50 basis points. He had a lot of tough talk for the market. There's no doubt that he is trying to talk the market down. They really don't want the stock market to go up right now. The numbers that they would like to go up are the numbers we generally don't want to go up. He would like to see unemployment at around 5%. It's at 3.7. So that's a lot of people out of work that aren't currently out of work. And the reason for that is because there's a lot of wage inflation. Wage inflation is one of the ways that inflation gets really entrenched in the marketplace, in the economy, because you have a job, and I'm going to pick on fast food because it's the quintessential teenage job. But when you got to pay somebody $22 an hour to work at Burger King or $20 an hour, it's really untenable. You can't keep that going. It's unsustainable. And what's going to happen is all of those higher costs start getting pushed down into the marketplace, and they stay there. They don't generally go away. So they're trying to get unemployment up so that there's a bigger pool of available workers, which means if you have a greater supply, if you've increased the supply, price comes down. So if you move along, supply and demand, that Economics 101 class that you took that you thought you'd never have to use again, I'm asking you to use it right now. If you have a shift of the supply curve to the right, prices go down. And he wants prices to go down. And in this case, the price is the wage. Now, I want my staff to know their wages aren't going down. So we increased wages because the demands are very high here at Edgewater Investment Group and the podcast. So I had to pay them more to stay. I'm not going to lower their wages when wages go down. We won't do that. So here's what I think is going to happen. January, 50 basis point rate hike again. February, 25 basis point rate hike in February. And then in March, a 25 basis point, and then stop. Now, there might be a stop after February, but the data is pretty hot still. And that's why I think they're probably going to go through March, and it helps their credibility if they kind of step down, do a couple 25s, and then they're out. I don't think that last 25 is what's going to drive us into a recession. I think that's already in the cards. And I think yesterday in the press conference, there was a lot of bluffing from the Fed chairman. He was talking a very, very tough game. We call that a big hat with no cattle. Talking tough, talking about keeping rates higher longer, going higher than what we thought. I don't think that's going to happen. And I think in late 2023 or early 2024, we're going to be fully entrenched in some type of recession. Nobody could tell if it's going to be deep or shallow or what it's going to be, but I think there is going to be a recession. The blame game will start, and you'll start to see kind of the rats will be fleeing from the sinking ship. But we are going to be in a recession, and that's the Fed's fallback position, is to slow the economy down, get us into recession, and then lower rates and try and drag us out of the recession. And they don't want to push us so far where we have deflation, because that's really hard to get out of. And that's why we have their mandate, the Fed's mandate, is full employment and price stability. Well, for them, that's about 4.5% to 5% unemployment is full employment. And price stability for them is 2% inflation. And the 2% inflation is there because they don't want to go into deflation. Deflation is way worse than inflation. People go broke in deflation. People are just out of work for a little while in inflation. And so the buffer that they have to stay out of deflation is 2% inflation. So that's where we're going to be. So what's going to happen? Well, for one thing, the bond market will be back in play significantly, and really for the first time since 2006. And I prefer to wait until we're right kind of at the pinnacle of the rate hike cycle. And I think that's going to be January. I could give the Fed another 50 basis points in February and March, or 25 just in February. I'm close enough, because I think when they do come back the lower rates in late 2023 or early 2024, they're going to be doing that in 50 basis point cycles. So they're going to come back. The first one is going to be, well, we need to shock the economy awake. And so they might do a big rate cut. Remember in 2008, we were going by 1%, and those were pretty big. And we might, I don't know that we'll see that. It depends on the depth of the recession. So I like the bond market in a variety of different circumstances. I like corporate bonds, especially big corporations. Government bonds aren't beating inflation right now, but you could get a 1 year, as of today, a 1 year government bond guaranteed by the full faith and credit of the U.S. government, about 4.6%. That's not a bad rate of return for 1 year money. And in the corporate bond market, the risk is that company isn't in business when the bond comes due, so you don't get paid back. So I want to use bigger companies. You don't need to take a lot of risk in the bond market right now, so don't do it if you don't have to. And I think the stock market's probably going to remain a little bit weaker until the rate hikes are closer to being on hold. So if you are buying, and people who manage money are always buying stocks. They don't stop buying. They just tend to shift the focus to other things, other companies, other stocks, other sectors. So a lot of big money managers, something that we're doing right now too, is we've taken the focus off some of those smaller tech companies because they live on borrowed money. Borrowed money is very expensive right now. They're not doing very well. So if you're buying stocks, what I'm doing is I'm staying with high quality, low debt companies, names that everybody here would know, and maybe not some names that everybody would know, but bigger companies. And energy to me is looking pretty compelling because it's a great hedge against inflation. I think it's better than gold because we use energy every day. When was the last time you used gold in your life, except maybe I have a gold wedding ring? Maybe you have a gold chain that you wear with your shirt wide open, and your hairy chest sticking out. I don't know what you do, but when I look at, we've always been taught in this industry that gold is a great hedge against inflation, but why isn't gold $5,000 an ounce right now? It should be. We have rampant inflation. It's the highest inflation we've had in a long time, and gold hasn't caught a bid. In fact, it's negative. Why isn't Bitcoin $1 million a coin right now? Aside from all the frauds and deceits that are going on with FTX, that could be a reason. But Bitcoin was supposed to be a hedge against inflation. Neither one of them worked. What does work is energy. And I think energy is going up in price because China's coming back online. They're going to abandon the zero COVID policy that they've had now that President Xi is president for life. And I think energy prices are going higher. They're pretty low. Gas is pretty cheap right now in the United States. It's not anywhere else in the world, and I think we're about to see that reverse also. Now, I want to make sure that you guys know too that when I'm talking about the bond market or the stock market, it may or may not apply to your personal situation. So I don't want you to go out and necessarily buy something because I said that's something we like. It's got to be right for your personal situation. So it's not an offer to buy or sell anything. I want you to evaluate what's right for you. And that's when in politics they say all politics is local. So when you vote for mayor of your small town or your big town, in general, it doesn't matter if they're, at least in my small town, it doesn't matter. I don't even know if our mayor's a Democrat or Republican. I know I like him, and he does a lot of good things for this little town that I live in. And portfolio management, when it comes right down to it, is really local. It's about what's right for you, not what's right for your neighbor or what's right for your boss or some employee that you have, or even what's right for me, because your needs are going to be different. And I had somebody in the office this week, and they need income out of their portfolio. They're a little bit younger, but they need income. They're retired. And so are they going to own as much stocks as some of our other people? We don't need to. We're going to go to the bond market for them. So it really comes down to when you manage a portfolio, these financial planning basics, the hallmarks of financial planning, the building blocks, kind of the foundational principles, which are you got to have a budget and know what it is. You got to have emergency fund set aside someplace where you could access it in case there's an emergency. A lot of people don't like to use credit cards for emergencies, but I don't mind if you had an emergency on a Saturday night, you use your credit card if it's a car or something like that, and then you pay off that credit card. And the third financial foundational principle is really managing your debt. Not all debts are created equally. So house debt is a little bit different than credit card debt. In fact, it's a lot different. Credit card debt is a wasting debt. Once you've spent that money on the credit card, that whatever you did is gone. So that dinner you bought for somebody that doesn't even like you 2 weeks ago, you're going to be paying for that for months. So you want to be able to pay off your credit cards every single month. And when you can't do that, alarm bells should be going off in your head because something's happening with your finances where you're spending more than what you got. So you got to satisfy those foundational principles, and then we can invest. So when people come to me and they say, yeah, I've got some money to invest, and I look at their finances and they got 50 grand in credit card debt, I don't take their money. I can't. I could guarantee them a rate of return if they just pay off their credit card debt because they're going to avoid a 20% interest charge. So we got to manage those debt levels. That's critical. If you want to be successful in your finances, you got to manage your debt levels. And if you're managing your debt levels, I know you're probably pretty good with money. So I want you guys to reach out to us. I'm glad to be back on the podcast horse again. Be patient with us. We're going to have some growing pains. We're going to make some changes to the podcast as time goes on because we've got some different inputs now. And I love to have people kind of challenge me and help us grow. So remember, 1-800-344-2534 if you want to reach out to us. At SkiBucks1 on Twitter. You can email Corey@EPSF.com. Ask your questions. We love to answer viewer questions on the podcast because I feel like we're really drilling down to the people who are listening and we can kind of get a little bit personal about it. I'm not going to tell you what stocks and bonds to buy. I'm not going to do that because we just can't get that granular here. But hopefully we can grow and help you build wealth over time, and we'll all be on a beach at some point in time drinking non-alcoholic Mai Tais. I am David Safransky. I am a real American and the voice you can trust.